Please welcome panel moderator, John Swartz.
Come on in, guys. Hello. Welcome to the Startup Playbook. I'm John Swartz. I'm with TechStrong Group. I was formerly at USA Today and Dow Jones, and it's good to be here. I haven't covered RSA in a few years, but given what's happening in security and the AI climate, I think it's really essential to be at this show. Before we start, this is going to be hard to do. I need a show of hands as I look into a cave. A show of hands of people who would like to ask a question near the end. We're going to carve out maybe 10 minutes, okay? And the questions would be from the aisles on the sides. Okay, so we'll leave about 10 minutes at the end for your questions. Thank you. Before we start, I want to introduce you to our esteemed panel. And so I don't butcher their names or get their titles wrong, I'd like them to each introduce themselves briefly.
My name is Chenxi Wang. I'm the founder and general partner of Rain Capital, early stage venture fund focused on cyber investments. I used to be a university professor. Now I'm doing cyber investments. And one of my portfolio companies just won the Innovation Sandbox this week. Very happy.
Oh, congratulations.
Congratulations.
Thank you.
Did you win, was it $5 million?
Yeah, $5 million.
Okay.
Project Discovery is the name of the company.
Congratulations.
Thank you.
So I'm Ari Kleinstein. I'm a co-founder and a managing partner at an Israeli venture capital fund called Glilot Capital. We started to invest in cybersecurity since 2011, invested in close to 40 startups, close to 20 exits, and we do seed and first round investments.
Hi, everyone. I'm Ken Gonzalez. I'm co-founder and managing director at NightDragon. NightDragon is a late-stage venture, growth-stage investor based here in San Francisco. We invest in secure tech, of which cybersecurity is a major part of that. And prior to that, spent years on the operating side as a senior executive at Siebel Systems, McAfee, Avast, and FireEye Mandiant.
Hey, everybody. I'm Tomer Weingarten. I'm co-founder, CEO at SentinelOne. At a point, I think we were the largest cybersecurity IPO in history. And we also have a $100 million venture arm called S Ventures. So I got a pretty interesting, I would say, vantage point into the topics we're going to discuss today.
All right, great. So this is called the Startup Playbook. It's basically we're taking a look at how to grow a company from a seed to an IPO in today's cyber market. And so we've kind of set up this narrative flow or the path or the journey into several sections. And I want to thank NightDragon for setting this up, and particularly to Sarah at NightDragon for organizing everything and setting a tone. So I'm going to start with a kind of a general question. And within a context of some news events that have been going on, Palo Alto Networks acquired Protect AI, and I think there might be other deals that could conceivably happen soon. Perhaps. I've heard from some, yes, indirectly from some people. There's this kind of push and pull drama with OpenAI, and its attempt to become a for-profit company, which is going to run into all sorts of legal actions and conflicts, perhaps, with the California AG as well as the Delaware AG, among others. So let's just start at the beginning. Let's ask, and it's out for any of you to answer. Whoever feels most strongly about it, please just jump in and feel free to interrupt one another, argue, tell me if I've asked a dumb question. I really don't care. I want you guys to have a conversation. So what are the key factors you look for in a cybersecurity startup at the seed or Series A stage?
I'll just jump in. I'm closer to him. So we are an early stage investor, so we come in at the ideation stage. So look for great teams who can execute and the idea that is compelling to the industry and to buyers and to us. But one of the things that we typically look for today is that how well they speak to the current technology climate, right? AI is obviously a huge shift, and so they have to be able to speak to it, have to be able to leverage the latest capabilities.
So I can add from my experience as a seed investor. So obviously, when you do seed investments, and that's true to any venture capital investments, it's mostly about the team. So we are looking for teams that have the vision, but also the tactical ability to execute in a market which is pretty competitive today. We're looking for big enough markets or problems to solve.
Yeah.
And that's not necessarily what's happening today, but 3, 4, 5 years from now. And obviously, if the technology is defensible, and I want to add to that, and this is, I think, specific to cyber. When we started to invest, that was 14 years ago, there were not a lot of teams that had prior experience in starting cybersecurity startups. Today, we have like second timers, third timers, and when I say second timers, it's not just necessarily the founders, it can be also the first employees in other startups. So if you join a startup 2 months after it was founded and get all the startup experience, that it's almost as good as being the founder yourself. So what we see today is a lot of founders that approach us with prior startup experience in cybersecurity.
You guys, I'll ask another question. Let's do that. How has the funding environment for early stage cybersecurity startups changed in the past few years? You want to try that, Ken? Or
I think the early stage folks keep going here. To be honest with you, I can't answer that.
You go first. How about
okay.
this time? Huh?
All right, yeah.
So I think that there is plenty of money in the market today for cybersecurity. I'm talking to many of my investors. VCs also have investors that are called limited partners or LPs. And everyone is looking to invest more in the space because it is considered high growth, kind of more immune to changes in the economy. It's a big problem, which I believe will continue to grow as the world is becoming more digitized. So it's definitely a lot of money that is flowing. I think that when it comes to early stage, most likely founders want to work with funds that already have prior experience in cybersecurity.
If I may interject, we place the seeding sort of strategically. I'm usually the earliest check-in because I'm on the ground working with founders, and they are maybe already has a product and can come in when they already have revenue and growing, and we ultimately want the company to be like Tomer.
Yeah.
Right? But not every single one can be like SentinelOne. So we're trying to find in the early stage which one of those 100 companies that we meet are going to become SentinelOne. And it's not a science. I mean, I wish it was science. Maybe AI will do investment better than we do.
Yeah, I mean, I doubt that. And I think that, I mean, along these lines, what we're seeing today, and at least when we look at founders today, I mean, given that technology is shifting so fast, and it's really hard to find deep IP companies anymore, given that there's literally almost no moats. So, what you kind of see is that initial concept either has to be incredibly innovative, like in a way that nobody else will be able to replicate with no amount of resources, which is almost impossible. And barring that, I mean, evaluating the team's ability to adapt to change, I think, is something that's incredibly important. Like even all the way to concepts like mental flexibility. Like you want people that will be able to kind of parse through really big issues and look sometimes at these big, hairy problems and then say, I need to pivot, I need to change, I need to look at it differently, I need to adapt what I'm doing. And to me, that's almost like an overlooked aspect of what you need in a founder today. You need someone that, a lot of these founders are really stubborn, right? I mean, they got their idea. They want to go there.
Because I'm wondering, how does that accelerate the situation or force companies to move faster than they would like to? How has that impacted things?
I think in many ways it accelerated the pace of development, so you can prototype really rapidly. But I think from there, that is not an advantage that is only for you. It's for anybody in the market.
Right.
So the moment you put your idea out there, anybody can replicate it. You know, you mentioned Palo Alto Networks. I mean, SentinelOne, we're platform companies today. I mean, we see everything that's happening. You know, Palo has been developing the same capabilities they acquired from Protect AI. They said so themselves. I'm not saying anything that's not public. So there's competing elements here.
I was at a YC event 2 weeks ago, you know, Y Combinator, right? So they invest lots of early stage AI companies. And the president of YC said that right now it's not uncommon for YC companies to do $50 million ARR with 5 people. Wow. And within less than 2 years.
Wow.
Yeah, I think that also changes the bar for what is a seed investment, what's an A round, what is product market fit. Is a company with $5 million of ARR had really proven something?
Yeah.
And you look at these acquisitions that you mentioned, and these are all subscale companies. I think these are huge bets even that corporates are making. And if you ask me, a lot of these acquisitions are no longer about technology. They're more about talent than anything else.
Also
But that's in scarcity.
strategic positioning, right?
Of course, and targeting big markets, right? I mean, everybody wants to own the next big market, the next big market opportunity.
Gen AI is the big change because we invested in AI companies for more than a decade, right? So AI on its own, it's not the thing. The second derivative is positive, right? So we see that the pace of change is actually increasing.
Wait, well, the second derivative just became positive recently. In the past, I don't think it's positive.
But it is now.
It is now, yeah.
And therefore, the question is, what is really more important? Isn't the R&D, is it the moat, or it's the go-to-market and commercial capabilities that the founders have in order to move ahead and grab market share?
Yeah, I could talk about a little bit on the later side. So on the later side, Tomer mentioned product market fit, and so what they've been talking about are things that from an early investor they're looking at. I don't know how to get a company to product market fit. That is not our game. I hope that you guys get them there. Our game at NightDragon is about scale, leadership, management teams, routes to market, business development, et cetera. And so when we think, and everyone has a different definition of what is product market fit, but and I'll speak for NightDragon, I can't speak for everyone, but for us, it has a lot to do with repeatability, right? When we want to get involved with the game, we want to see repeatability. And yes, we can look at all the traditional SaaS metrics, and we all know what they are. You can Google those. But what we really want to know is that the management of the company has their hands around, how do you go from a suspect to a prospect to a closed customer? How do you show that these customers are getting real value out of the product and solution, that they're evangelical in their use, they're buying more and more frequently and renewing? And so the SaaS metrics and pick your metrics, they speak to that. But also as a later stage investor, I want to go specifically into references. It's insufficient to have sponsored references. You better give me great references, right? I'm going to do the unsponsored references with your customers, and I'm going to make sure I understand how are they using the product, why did they select you, are they using it in an industrial way, are they getting real business value out of it, are they evangelical about it? That's a lights on moment for me as an investor, and I'll do the same thing with the partners. Now a company at a B or a C might not have full channels going, but they'll have some early partnerships, and the question there is really, does the partner see the market opportunity? Do they see this company as a leader in it? And are they willing to build a franchise around this business as a first mover on this new capability? And those are kind of lights on moments for us as a later stage investor.
Okay. This is for Tomer. When you were seeking your first investment, what challenges did you face and what ultimately helped you secure the funding?
Nobody wanted to invest. That was the first challenge that we faced. Look, I mean, we obviously were going into a brownfield opportunity if there ever was one. It was 12 years ago, it was the antivirus market. There was no such thing as an EDR. There were no new capabilities that anybody wanted to deploy on the endpoint. It was really, really hard to come up and say, hey, we're two nice guys from Israel and we have this prototype on how we're going to completely replace and shatter the AV market. And the big names then were Symantec and McAfee, to the CrowdStrike, SentinelOne. But back then, when you said something like that, I think it's it was virtually impossible to convince anybody that this is a doable proposition. I think the other thing that was really hard to do, and that was also one of my main reasons why I actually started the company in Silicon Valley. I'm born and raised in Israel. I moved here and then started SentinelOne. The level of difficulty I found in describing what we do, the actual core technology, why we would win against the antivirus vendors was really hard. I mean, what we built was, core kind of deep machine learning algorithms before anybody was talking about AI really. And people found it really hard to understand what's the differentiation and why is it going to be different. I think that today, I still don't see a ton of understanding. There is much better understanding about these technologies, but that still is a kind of a, do we believe it? Do we know what it's doing? How's it going to change the world? I think it's a bit hard when you're building deep tech to kind of come out there and say, hey, this is going to change the world in the very, very early stage. I think at some point it becomes clearer.
Okay. Did you want to say?
Oh, I was gonna. Can I ask a question?
Sure,
instead of you?
absolutely. Yeah.
Go ahead.
So, Tomer, when you were building your startup, you had maybe Cylance and CrowdStrike, these guys, right? So you have 3-4 competitors. Maybe?
No, I mean, when we started, and by the way, all these companies started in the span of about 2 years,
Yeah,
right? I mean,
yeah.
that's the entire thing. And everybody started doing something else, by the way, and there were 35 endpoint
Oh,
related
there were 35. Okay, I was
companies,
gonna say
right?
I knew of
And
a few-
CrowdStrike was a services company, and Cylance
Right.
was all about signatures and stuff. And everybody took like a different approach. Eventually, everybody converged towards what we all felt would be kind of a compelling proposition. We were the first company that actually said, let's replace the antivirus. At the beginning, everybody was trying to augment and kind of run side by side. But this is now, the has-been days of endpoint protection. Now everybody is, of course, it's replacement. But back then, there were very, different competing strategies on how you go to market, and that was
But
always
if
going
you
to be
were
different.
building your company today, I mean, I think these days, any idea you have, there are like 12 Israeli companies already doing it. Then there's another 10 US companies. So how do you rise up, with all the noise, right? So
Look, to me, and I'll let others kind of opine because they've met a lot of these companies throughout the journey. I stuck to like one very, very simple principle that to date, I don't know if it was the right thing to do, but it was just build the best technology you can. Like always invest in technology and go to market. We kind of mentioned it here. That was not my forte. And to us, it was always about we're going to build the deepest IP we can that will deliver the best outcome that we believe the customer would ever have, which is to be fully, fully protected. And when you keep that as a North Star, I mean, things become really, really simple. I mean, you just need to make sure that what you do the best in the world, and you get the best talent, and you have the best concepts and the best innovation, and you stick to your vision. And if that also aligns to a huge market opportunity that you're able to address with that technology, then I think it's open, right? Even if you have 5 or 10 competitors, today SentinelOne, CrowdStrike, Palo Alto, all of us, Microsoft, we're targeting $100 billion market opportunity. Nobody's going to own all of that. I mean, you're seeing Microsoft with $20 billion revenue in security, and you still have Palo Alto Networks, which is a $100 billion company, and CrowdStrike, and us, and everybody else. So we all have that notion that it's a one winner takes all type of a dynamic. It really is not, in almost no market in cybersecurity.
I'd agree.
It's going to pivot to the early and late stage VCs. What are the challenges in transitioning from early to late stage funding rounds?
Oh, well, so how much time do we have?
Yeah.
The challenges. So the talents that take to generate an idea and build a product in the beginning is usually not the talent that takes it to distance. Now, Tomer is an exception, and we'd love to find more people like him, but it's not always everybody's suited to run a $2 million company and same person to run a $100 million company. So finding the right talent is very challenging. And also, you have to be like, the company has to be valuated at the right valuation for the market. And that's been a little bit challenging too for the recent market dynamics.
I think that Ken gave the right answer in the sense that we know what the late-stage investors are looking for. So when we are working with our early-stage companies, it's exactly about that. It's about scalability. It's the ability to actually position your company as a category leader, or maybe number 2 or number 3. You definitely don't want to be number 35 on the list.
No,
For sure.
And then Ken has to be convinced that he's going to make money on NightDragon's investment, which means that the company has a lot of upside from the B round, from the C round, which means that we have to work on all of that, and that's challenging. So we need to build the right team in addition to the founders. We need to see that the technology is actually defensible. And it's, as we said before, it's moving so fast that you actually every year has to check yourself and still see that you're actually ahead of your competitors, because there are always like other younger companies that got funded and might, become leaders. So it's a very, very challenging environment these days.
So there,
very hard,
go
right?
ahead.
The only thing I was
Sorry.
going to add, and I already spoke about, product market fit and repeatability, and I think we hit a lot of good things. And yeah, absolutely, by the time we're looking at it, we expect some augmentation of the management team. It doesn't need to be fully built out for a B or C investor to come in. But, good understanding of their business. We spoke about metrics, but other things include, vision remains very important as a B and C round investor, because, we'll talk about what it takes to get public, but, generally speaking, a company by the time they go public is more than a one product company, right? Their second product is probably humming along at 50 or more million in sales, and they probably have a strong view as to what that third product is. And so we want to make sure the management team has a vision about how the market might develop, that there's going to be another act over time as we grow and scale the core business. Put another metric thing out there. Unit economics is also important. We all invest in both software as well as hardware-oriented companies, and gross margins, unit economics do matter.
We talked about talent. What about timing in terms of when a company is ready to go for Series B or C funding, and how do you assess scalability, long-term viability, and later stage investments?
I think we kind of hit it a little bit. It's how big is the market? How is that market developing? I want to see that company, again, can grow out of its initial market. And that could mean grow to different segments, be it SMB to enterprise. It could mean growing out of the initial market from an industry perspective to an adjacent industry that looks like it. Maybe a company's doing really well in, financial services. It's not a huge jump into insurance and health tech, for example, or healthcare. And then I also want to look at the applicability of a solution to scale internationally. When companies go public, the biggest of companies tend to be 50% US, 50% international in our market. It takes years for companies to get there. When I was at FireEye, I don't think we ever got there. But I want to see the initial stages of a thoughtful strategy to expand to other market segments, industries, as well as geographies.
So this is for Tomer, and kind of crossing the chasm to the next phase of growth. What were some of the obstacles, and when do you know you're ready for the next round of funding, and how do you maintain company culture and innovation while scaling rapidly? How do you do all that? It's like a balancing act.
I don't know. Being ready for the next round of funding, I think, you're kind of always in flux between rounds of funding if you're growing fast, which kind of was our story all throughout. Even today, we're still one of the fastest growing public companies out there in all of software, which is kind of crazy. So you're kind of always, you have your ear open. I think the best rounds that I've raised were ones that I was not setting out to raise, and the ones that I set out to raise turned out to be the most difficult ones to raise. I don't know, it's karma or whatever.
When you want it, it's hard to get.
For sure.
I heard this yesterday from a founder I thought was great. They said, you're never raising, but you're always raising.
Oh, for sure, 100%. I can totally relate. But also, you constantly want to find ways to invest more in things that are working in your business. And you really want to be very cognizant about what's not working as well, so you don't invest a lot there. But when you have these abilities, especially as a private company, because I think the art of everybody here and for private companies and VC money in general is that you can just scale like crazy, right? I mean, nobody cares about your margins. Nobody sees your margins. Nobody's asking you about efficiencies right now. It's really, if it's working, plow some more money into it and go grab market share, which is generally, I think, somewhat sensible. I think you do want it to be under a certain efficiency, I think, metric, but it's not mandatory. I mean, we've seen very successful companies exit before anybody had the chance to even look at how inefficient they are. I mean, you see all these glitzy...
And the company that buys them then discovers how inefficient they are.
I think, look, they know, but sometimes it doesn't matter. I mean, if the company has asserted dominance in the market, nobody cares that they poured $2 billion into marketing, right? So that's the way.
We're not talking about any specific
No,
companies here.
nobody
No.
specific, nothing.
You don't want to be number 5 or 6. That's I think, the whole game. So
Yeah.
whatever it takes, lead the category, be number 2 if you can't beat number 1. But the lower you go, your value decreases exponentially.
Yeah, let me ask you, so is like a magic number? You say could it be 1 or 2? Could it actually be 3 or 4 companies, or is that maybe pushing it too far?
I think it depends on the market and the
Sorry, we're speculating when we always are speculating about AI market and who's going to be who the winners and losers will be. It always invariably comes back to, well, look at what happened in tech earlier.
Yeah.
The waves. There's always 3 companies usually in a specific area. And I just wonder, given the size of this market or the potential for it, whether that number might be larger. I think
that it's all about which market you're in and what timing it is. And so my background, before I started Fund, I was Chief Strategy Officer of Twistlock, which was a container security company, and we were one of the first. We came to the market pretty early, actually. I remember talking to companies where they were like, oh, I only have 1 container server, not sure I need you. But we were that early, right? So there were 3 companies, really 3 companies that mattered, us and StackRox and Aqua, right? And so we were acquired pretty quickly, I think less than 4 years, and then StackRox chugged along for a while and also got acquired. And then there's Aqua, which grew, and I remember after we got acquired by Apollo, people said, oh, you guys got acquired too early. Because look at Aqua, they're growing. You know, they're going to go public. But now you look back, you're like, not sure where they're going today because market has shifted. So you kind of have to make that decision and also have the vision to look around the corner if you can, right?
I mean, let's look at history for a second, right?
Yeah.
I mean, in cybersecurity, let's take the endpoint market, let's take the network security market, the 2 probably biggest markets in cybersecurity. You asked, 1, 2, 3, 4, 35. I mean, where is that chasm, right? McAfee, Symantec, Trend Micro, Sophos, Bitdefender, Webroot. This is before like the days of EDR. So only in endpoint, you got like 7, 8 scale players, 5 really big players. Network security, Checkpoint, Palo Alto Networks, Fortinet, Juniper, Cisco, SonicWall, like you got a bunch, right? So I think people kind of tend to miss that because you zero in on the most successful ones. And those are the ones that become maybe more kind of brand names, household names. But this market is huge. People, I think, have a really hard time parsing through what $100 billion really looks like. And again, if you think, somebody like Microsoft, which is a mammoth, right? Their entire cybersecurity revenue is about 20 billion. So actually, it's about 1/5 of the entire TAM across all the different security offerings they have, but it still leaves $80 billion. The second biggest one would be Palo, maybe with $10 billion. Then you got, CrowdStrike with about 4. So it gets really, really slim after that. So there's a lot out there.
Yeah.
Don't despair, startup founder.
Yeah, it's interesting. I would say it's an interesting market too, and I contrast it with other markets that historically have had the 50% market share vendor, and then everyone else thereafter. Right? Take a look at showing my age here, but the database market, the ERP market, the Salesforce automation market, the browser, a lot of those all had the 50% vendor, the 30, 25% vendor, and then everybody else. And we never really saw that in cybersecurity. We've always had plenty of opportunities for everyone to execute amazingly well on a brownfield opportunity to displace people, to create new categories. And I think that remains today. I think one thing to think about, I tell you, I get questions from investors when I raise capital is, okay, if that's the case, then are returns capped because there will never be, you're not going to be able to back the 50% market share vendor, which is
That's a
whole nother
good
debate.
question, though. When I face the same problem when I go raise funding for my fund. Some of the investors will say, hey, why would I invest in a cybersecurity fund when I think the return is capped, right? Because you're never going to get that Facebook. You're not going to get that Google. And so why should I invest in your fund? And that, it's a bit of a tricky question to answer, but they're not wrong. Right?
I think it's, we raised the first fund to invest in cybersecurity in 2011. At that time, the market cap, Palo Alto was not even a public company. It was still a private company. When it went public, I think the market cap was maybe $4 or $5 billion, if I remember correctly. Now it's more than $100 billion. Right? Checkpoint is 25. CrowdStrike is close to 100. The market changed dramatically. Yeah. Where is it going to be 5 or 10 years from now? I'm investing, hopefully, in the Sentinel-1 of 10 years from now. Yeah. So I think that we are going to see companies that $200 billion, Sentinel-1, hopefully, $300 billion. Google today is at so the market is growing. Yeah. We still have a lot of upside.
I was going to ask Ken this, kind of in late stage area. How do you guide founders in balancing the growth with financial discipline? In other words, with this, we think about the fluctuating public markets as they are, how would you advise startups on an exit strategy, IPO or acquisition?
Good question. So we'll talk about this. So IPO market, it's cyclical, right? There's risk on, there's risk off. Right now we are risk off. I don't think there is an IPO market. In fact, we just announced GDP decline in Q1 today.
Right.
Last year was, I'd say, a risk off in a tight IPO market. And depending on, and then kind of 21, 22, a much more open market. So depending on where you are in that cycle, the metrics to get public differ, right? In bullish times, it's 150 to 250 is a sweet spot. You better have a market cap north of only kind of in bullish times $1 to $2 billion in market cap. You better have a few quarters of metrics and pretty good visibility. And in risk-averse times, all those metrics get bigger. You better be a $3 billion IPO. You need to have 8 trailing quarters. You got to have 350, 400 million in sales. So me as an investor, I'm
500 million.
500 million, great. So as a later stage investor, yeah, I want the prize. I think the value maximizing scenario generally is the IPO. Liquidity is another thing, but the value maximizing is the IPO. But what I coach our companies on is that more than likely there's an acquisition at some point in time, and as we all know, you'd rather get bought than have to sell your company. And so how do I engineer a buying opportunity from the get-go? And that is, at the point of diligence in a company, we at NightDragon, we will sit down with management. We'll use our own brains as well, and we will identify the most strategic partners to this company that we're getting ready to invest in. The most important technology partners, the most important go-to-market partners. And frankly, we'll invite them into the diligence process. I want to learn from them. I want to see if they're seeing what I'm seeing. I want them to confirm it. Nobody, if they love it, I want to invite them into the syndicate so I, day one, get alignment with those partners. Even if they don't invest in the company, I want to plant the seeds for a great relationship there, ideally a partnership. Because moving towards M&A now, as my company executes and grows, I want that partnership to be valuable to them. I want the potential acquirer to know, who we are, why we matter to them strategically, why we matter a lot to their customers, and I want to bring them on the journey periodically so they know where we are. Because one day, ideally, one of those strategic acquirers is going to knock on this company's door. Yep. And at that point, it's too late to go educate the 3 other logical buyers. I'm too far behind the game. The person who's coming in is probably going to drop a term sheet that's going to expire in 30 days. Whether that really happens or not, sometimes it's debatable, but I need to move quick. And so to maximize M&A outcomes, well, to minimize M&A outcomes, but you're still getting sold or bought, is to have one buyer. The second best or second worst alternative is have a buyer and a credible bluff. I mean, frankly, when we sold McAfee to Intel, Intel was the buyer. We had a credible bluff with somebody else, right? Back in the day. But the magic happens. The leaps in M&A value happen when you have two credible buyers, and amazing if you have three credible buyers in the game. And to manufacture that in the time where all three of them can be educated and bid, it takes years of prep work to get there.
But the ecosystem that you guys build is incredibly important, right? So you helping with all the channels. And yesterday I had a conversation with a founder here, and he was asking me, he said, how do you price the valuation of the company? We have all these metrics, and the other company had all these metrics the same, but they got valued higher than us. And I said, it's not about today. It's about when you go for funding, it's not about today's metric. It's about 18 months from now, how much someone's gonna put a valuation on the company. The reason that you got a lower valuation than the other company who had the same numbers is because that company had built an ecosystem, and that ecosystem is gonna turn positive outcomes threefold in 18 months, and you don't have that. So as founders, you really have to look to the next round to know how this round's investors are thinking.
Okay. So in a couple minutes, we're going to open up the floor to questions from you all. But I want to ask Tomer one question before we do that, and that was, what are the biggest surprises or challenges in taking your company from early stage funding to an IPO? And looking back, what would you have done differently from seed to IPO?
Oh, wow. I mean, we don't have enough time for that, for sure.
You got 3 minutes and 53 seconds.
Many different things, I would say. I think the biggest thing we kind of chatted about is, in backstage, when we IPO'd, we IPO'd at a relatively low scale because it was possible back then. But today, I would strongly urge anybody that's thinking about an IPO to not contemplate it unless you're close to like $1 billion in ARR. I think to be durable enough in the public eye and to kind of survive the qualms of Wall Street and what public market investors and shareholders expect, you got to be a very durable business. I think that that's something that you've seen probably in the past few IPOs, the few that did go out, there were like 500, 600, 700, they're all starting to scrape the $1 billion. I think if you're trying to do anything below that, I mean, the public market is not the place for you. So I think that's one of the biggest things. Look, to me as a first-time CEO, and I think as a founder that's now a public company CEO, all of it is a surprise. I don't think you can expect any of it. No matter how much you read, no matter how much you will talk with other public company CEOs, I think the experience is unique. You're jumping into an ocean, with a small raft, and you're hoping to find land at some point there, and you're just trusting the process to a degree. But look, if you want to truly drive innovation in this world, I think this is where M&A most often, at least what I found, is not going to get you there. Like if you want to pursue a certain vision, if you believe in the change you're making, you gotta drive all the way there. And I think that's the only incentive you have to IPO. It's not probably the greatest exit that I've had in my life, and it doesn't matter to me that much. I think the purpose, the mission, what we're doing is the reason. And as long as you got a great team with you that's willing to jump on that same raft, and people will come and go for sure. That's the only thing you should care about.
Okay, good answer. If you all have questions, can you raise the lights up a little?
We can't see, yeah.
Yeah, we can see you better now. If there's anyone has a question, I think somebody, wait.
Don't be shy.
Don't be shy. You can just yell it out if you like.
But the question was basically, hey, you see your competitors getting bought. How does that affect you as the person not getting bought or as the investor in the company getting bought? And Boy, I tell you, I don't think there's a right answer there. I mean, I've bought 40 different companies when I was on the strategic side, and boy, I've looked at companies and knocked on doors and maybe not acted, but seen their competitors get bought, and then ultimately the company did amazingly well. I mean, I probably spoke with every EDR vendor before they went public at one point in time. You know, I took a hard look at Proofpoint at one point in time and passed, and look how amazing successful they've been. I took a hard look at Splunk when it was a private company and passed, and look how successful they were.
Yeah.
So I think kind of to Tomer's point, right? Like, I'm investing in a management team that wants to go for that IPO, right? And we have to be sober and aware if, you know, we look at the private markets are too tight to raise capital for that next, whatever it is, then maybe you take an off-ramp, particularly if someone comes with a preemptive kind of M&A opportunity. But man, if you're the founder and someone doesn't want to buy you and you're actually delivering the goods and you're on a mission, and there's investors that are willing to fund you, then keep on running. And there's the public companies, markets that are filled with companies. Probably all of them had opportunities to get bought at one point in time. Heck, when I was at FireEye, I'll just tell you there was a large public that bought, that I was in the meeting. I sat there across from the CEO offering to buy us, you know, a month before we went public. And it was like, sorry, we're on a mission here. We're doing it.
So Ken and I know each other from almost a deal that happened when Ken was at FireEye. The way we look at it is that in cyber, we let the founders make the decision. Okay, so if they want to sell, or when we invest as seed investors, the idea is to create a big company, to have the next SentinelOne or FireEye. But if the founders are getting a good enough offer, it's their decision to make. It's their life, it's their future, it's their company, it's their money. And well, there are plenty of opportunities out there. We sold, you know, a couple of companies to Palo Alto Networks, to Check Point, to Microsoft. There are many good, rich buyers out there. And if this is the right decision for the founders, it's mostly, in most of the cases, it's the right decisions for us as well.
Well, is the meaning behind the question about how investors thinking about companies as investors, as competitors get bought, or how founders should be thinking about? What is the
underlying point is you're selling a vision, right? You're saying, oh, we are building this company. And for the last 2 years, the only occurrences are those biggest competitors are being bought out and acquired.
Yeah.
There's really almost like no indication that these companies will grow to something big. And that's the concern I'm thinking about. Like, how do you actually persuade or sell?
Not necessarily. It depends. You know, we've seen the acquisition of Wiz by Google, right? So there are other CSPM companies or Synapse that got acquired. Sometimes it's good news because if the price is right, it's high, then you have already a comparable. Sometimes it's less competition because it happens that big companies actually can kill the startup that they're buying, and you're not going to see them in the market as effective competitors anymore. Mm-hmm. So in many cases, it's actually good news. If the acquisition was with a low price, or it's by a very aggressive competitor, and now they're going to have big market, like a big company behind them, it might be bad news. So but in most cases, I would say statistically, it's actually good news.
Yeah, I just want to add, I mean, quickly, like, to me, I look at these acquisitions, and it's almost universally good news all around. I think it's, you know, it's good news for the investors. I mean, they got some return. By the way, up until the last few years, if somebody had exited for like $1 billion plus, that was a tremendous exit, tremendous exit. So we have to also calibrate that Wiz comes, you know, once in never, right? Never happened before. So we have to calibrate. And the other thing is, you know, when you're kind of looking at that Protect AI acquisition and Wiz and all of that stuff, like, to me, that's also good news. I mean, I always thought about these types of acquisitions, like, okay, you know, competitor out. And at the same time, they're now almost fully relegated to two things. One, to integrate with the acquirer. Two, to the estate of customers that's applicable for that acquirer. In the case of Palo Alto Networks customers and the attach rate they're going to have for that you know, solution over time doesn't block the market. Even in the case of GCP, which is obviously much, much bigger, what about AWS? And what does it mean for AWS customers, right? So does that open the door actually for Orca, for us, for other CNAP players to become more dominant in other places? May or may not be. I'm not suggesting, but just think about these market dynamics as things that are constantly kind of adapting and shifting. And again, acquisitions, they're good for everybody. They're also good for the acquirer at the end of the day if they're making the acquisition. Sometimes they pay a little bit too much, but outside of that, I mean, it does open up some more sales for them.
Okay. Do we have any other questions? If not, oh, you, yes,
one in the back.
sir? Yeah, I can barely see you, but come on down.
If you have questions, you can line up so that we
Yeah,
save the
that'd make it
time
easier,
of moving to
but-
the microphone.
Hey, how are
Good
you guys?
hustle.
So, Brian McGuire, Foxfall Labs. I was kind of curious about, as a small startup that's going into the seed round there, what metrics are you guys using as investors to break into an emerging market, for a company that's breaking into an emerging market?
Well, I can talk about that because I'm a seed investor. Depending on where you are in the seed stage, there are companies raising seed without the product, right? Do you have a product? Do you have early customers? How much the customers are paying, how much customers love your product or don't like your product, and also how quickly you are gaining momentum. It's the velocity, it matters a lot in this market today. Does that answer your question?
Yes. Thank you. I appreciate it.
Other folks?
Do you guys have any other? Do you want to wait? I'll ask you a question, kind of to everybody, and it's kind of the easy takeaway question. It's like, do you have a piece of advice to founders navigating the funding environment, and what would it be? We've got about 3 minutes, so if
I
you
think
could,
that there is like the first,
rapid fire.
Rapid
first
fire.
commandment, like in the 10 commandments to founders,
10 commandments.
raise money when you can. Okay, because sometimes I have these discussions, and I'm sure that my peers here as well. Let's wait a bit, let's get to a certain milestone. Let's have another version of the product out in the market. We live in a very dynamic world, right? So you don't know what's happening. If you have now the opportunity to raise money, do that. So.
I have a slightly different view, can I say that? Because I'm feeling very strongly about raising money and not raising money. And of course, we don't want a we don't want a like lifestyle company, right? You just grow a little bit, and then that's no way to generate an exit. However, your goal should be building a sustainable business. That's your first goal. Your goal should not be raising money. These days, we see companies are actually pure fundraising companies. They're not building products. That you should not be building one of those companies.
I totally agree. I would say, build it so you don't need to raise money, and then raise money to scale it. I think that would be the utmost best recipe that you can. Because again, especially in the world of today, you just don't want to be dependent on any external funding, of any sort. You can take some money to bootstrap, to seed, to put these foundations, and from there on out, design it to the best of your ability is something that's self-sustainable.
Yeah. And the only thing I'd add is the message there, control your destiny. Later stage investors, we do expect, when we invest, we do expect that company to take our capital and burn it at some rate, typically over 18 to 30 months. But boy, if the private markets are tight and you're not hitting your metrics, do what you need to do to change your assumptions, change the way you're doing your business, and maintain control so that you do control your destiny.
We have time for one quick question. I'm so sorry.
Okay, go ahead.
I want to let him ask one last question. I'm
This
sorry.
is Khwaja Sheikh, fascinating panel. My question is on the corporate board oversight. What kind of advice would you give so that corporate boards also have VC mindset so that they can infuse, they can oversee the management so that they can also spur inside the company in the startups?
Corporate boards, you mean public company boards?
Yes.
Ah,
I mean, typically you don't really have VCs on public company boards. And I think, you kind of go through the stages of maturation and you get a lot of VC, I think, opinions throughout the road. But then you get to be a public company. I think the game is very, very different. And you basically need more public, board directors anyways, so it doesn't always coincide. So I would say look for people with the experience that you're lacking. That would be my number one advice. And, be pragmatic, listen as much as you can, try and be as transparent as you can. Don't try, be as transparent as you can. I think that has always served me exceptionally well. What I know, my board knows, there's no level of separation between, what we all know about the company, and that makes things very, very easy. And then it matters much less who's on the board because everybody's really on the same boat and everybody just wants the success of the company.
Public boards about governance. It's not about growth and innovation. VC is about growth. It's very different.
Hey, with that, we've run out of time. And thank you very much for being here. I learned a lot. I hope you did too. I want to thank our panel. They were fantastic. And I hope you have a great show. Thank you.
Thank you.